This week in markets, the US Treasury leans short-term. Europe sends a powerful message on enlargement, and Beyond Meat's meme stock moment collapses. Here is everything you need to know from yields to geopolitics and why it all matters. On November 5, the US Treasury confirmed it will increase short-term borrowing while keeping long-term bond issuance unchanged. That might sound technical, but it's a big deal. It means Washington is betting that interest rates will fall soon, so it's avoiding locking in today's high long-term rates. Right now, the yield curve is almost flat. 3-month bills at 3.84%, 10-year notes at 4.08%. So why pay more for long-term money when you can borrow cheap and short? This strategy gives the government flexibility, but it also adds risk, because if rates don't fall, those short-term debts will need to be refinanced at possibly higher costs later. Economists expect US bill issuance to jump from $344 billion this year to over $550 billion by 2026, while long-term bonds decline. The short-term win, lower interest costs now, the long-term risk, higher refinancing pressure later. Markets took it calmly. Yields barely moved, showing investors trust Treasury's balancing act. But it's a reminder, even in the world's largest bond market, timing and flexibility are everything. On November 4th, the European Commission released its annual enlargement report, and the tone was sharper than usual. Ukraine, Moldova, and Montenegro got praise for reform progress. Serbia and Georgia, not so much, flagged for democratic decline and weak rule of law. The Commission said Ukraine's goal to join the EU by 2028 is ambitious but achievable. Serbia, however, risks falling behind due to media freedom and judiciary concerns. And Georgia got the toughest words yet, the EU calling it a candidate in name only. For investors, this is more than politics. EU candidates with momentum like Ukraine and Montenegro could see more foreign investment and infrastructure funds. But lagging countries may face hesitation and slower capital inflows. And for the EU itself, this isn't just bureaucracy, it's strategy. Enlargement has become a geopolitical tool, tying economics and security together as Europe tries to stabilize its neighborhood and counter Russian influence. The next few years could redefine Europe's map and its market. And finally, Beyond Meat. Let's talk about it. On November 3rd, the company said it would delay its earnings report until November 11th. The reason is an impairment charge, meaning some assets are worth less than they thought. And markets, they didn't like that. Shares dropped up to 16%, erasing much of the wild 240% rally in the stock. So in October, during a brief meme stock revival. Beyond Meat's deeper problem, it is falling demand. Consumers are shifting toward whole foods, high-protein diet, and even weight loss drugs like Wegovy and Zepbound, all of which hurt the processed plant-based meat market. The company's costs are up, margins are thin, and investor confidence is fading. The delayed report is now a credibility test. If Beyond Meat can show a real plan for cost control or product realignment, it might regain some trust. If not, the stock could continue its slide. So to recap, the US Treasury is borrowing short-term to buy time. The EU is reshaping its borders and its ambitions. And Beyond Meat shows that hype fades, but fundamentals always matter. If you enjoyed this breakdown, hit like, subscribe, and let me know in the comments which story you want unpacked next week. Until then, stay informed, stay rational, and keep your returns compounding. Thank you so much for watching, and let's build the bridges and not burn them. Goodbye.